Well, good morning or good afternoon, depending on where you are at. Hopefully, if you're a bear, you're not getting crushed this morning. Excuse me. Afternoon, Brenda. Obviously, you're on the East Coast. It's still morning time out here. I haven't even finished my third cup of coffee yet. So here we are. I finally figured out, though, I can use this one with the lid so it'll stay warmer longer. I do have a Yeti, a couple of them, but they stay too hot too quick. So I don't want to scald myself while I'm trying to talk. Anyway, hope you're all doing well. Welcome out to Trading Coaches Playbook. Oh, interesting. I just noticed something about the markets. Maybe we'll talk about that a little bit later. They all are hitting their 50-day moving average, except for the NASDAQ. It's slightly above it. But the Russell, the NASDAQ, and the Dow are all gapped up, hit their 50-day, and they're starting to sell off a little bit. So, interesting. Only one? Holy cow. I know. I think my brother's like that. Caffeine affects him very differently. It's a massive stimulant. For me, being a little ADD, as I think most of you know, it more mellows me out than anything. So, but I don't know. A few years ago, I got a really good coffee machine, so I just hit a button. I roast my own beans most of the time. If I don't have time, I sometimes default to the stuff you have to buy in the store, and it's fine. But it's very different when you get freshly roasted coffee. It's just so much better. So, but my roaster got funky last time I used it. It stopped in the middle of this thing, which was weird. Had never done it before. So I might have to be getting a new one of those if it goes out. But let's get to it. Trying to give the stragglers a couple minutes to get here. So 16 ounces. I don't know how much this is. I think it spits out like 10 or 12. So, but I think you've probably all seen this disclaimer before, right? I'm not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume that it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. So I know your cat's not here, but usually she's Brenda. I just noticed she's not up there. I don't know where she's at. So here's what's coming up with Wealth Builders HQ, the premium online workshops, Inner Circle, May 6th and 13th at 7 p.m. And then you want me to stop and go find her? I'm sure she'll make her way in here. She's almost always in the same room with me. So, but she's been acting kind of weird lately. So, and she looks like she's lost a little bit of weight. So I'm worried she might be sick. I don't know. She's still eating. But Mastering the Trade is also May 6th, but at 8 p.m. Mastermind Group monthly, May 7th, 8 p.m. Eastern time. All these are in Eastern time because all you weirdos are on the East Coast. Just kidding. Y'all like, how do you get up and trade that early? Because the market opens at 6:30 out on the West Coast where I'm at. I mean, you're used to it. It just is what it is. And I'm usually an early riser anyway. So, but here's the beauty. You're done at 1 o'clock. So like today is sunny right now. Market closes. If I'm done trading, I don't have anything else to do, which is rare anyway. I can go do whatever I want after 1 o'clock. I have the whole afternoon to do what I want. So, which realistically, that's the beauty of trading. That's probably why you're here. So you don't have to sit in front of the screen. If you're on the East Coast, you could leave at 1, 3 hours before the market closes. You just automate your trades, put them on autopilot, and walk away and do what you want. That's the beauty of technology. Now, when I started back in 2000, we didn't have what we have today. You couldn't automate it like that. You had to babysit it. So, E-mini Think Tank Q&A is May 14th at 8 o'clock. Patterns and Flash Q&A, May 15th. As I say, that is right. It was originally supposed to be next week, but we bumped it to the week after. So, free online workshops. Power Hour was every Monday at noon. Trading Coaches Playbook. This one every Friday at noon. Oh, that's a good idea. Thank you, Brenda. I didn't even think about that. Getting the cat litter that detects stuff in the urine. I might do that. I need to order a bunch of stuff off Amazon anyway. Power Option Plays is every Monday and Thursday. Cover Call Explorer with Trip on Thursdays, and E-mini Think Tank Monday, Wednesday, and Thursday with Brandon. So there we have what is coming up. Of course, you can find this on all the social media platforms. Seems like there's a new one. Oh, no. Well, maybe. If we haven't met, I don't know if I said it. My name's Tony Benson. I'll be your guide for a little bit here. We're gonna have a little bit of fun and play with some numbers. But if you're not familiar with me, Patterns in Flash is a tool I created years ago. That is the purpose of that is to train your eyes to see the patterns in the charts on the right side of the screen before it makes a move. Because obviously, if you see a pattern and 6 months later, it's in the middle of the chart, you can't do anything about it, which is where that tool came from. Because I got frustrated when I started. I learned patterns, I start to recognize them, I'd see them, but it was in the middle of the chart. Like, look at that inverted head and shoulders. That's beautiful. But it was 6 months ago and it made a massive move. And you obviously can't take advantage of that pattern then. It's too late. So you got to learn to recognize the pattern on the right side as it develops. That way you can plan and prepare and have your trade ready so that when or if it triggers the entry point, you can be there, right? So that's what that's about. It's flashcards, which is the first part of it, right? Which is the training mechanism you use to train your eyes to see the patterns. And then there's 7 or 8 hours of video in there about how to utilize the pattern, basics like foundational technical analysis stuff, each pattern individually. There's just a lot of really good stuff. So even if you're not new to charting, you'll gain something out of that guaranteed. Weekly Whispers is something we launched the beginning of last year, which I was just talking to Rob, but it was like, why not take my analysis? I mean, basically what I do, I'm a patterns trader, right? Obviously, somebody dubbed me the pattern whisperer. I don't know who it was, but it was flattering and humbling. But I go through my charts once a week and look for patterns. And on the right side that are setting up, that are potentially could give us a good trading opportunity. And then I go through and 300 to 400 stocks, I look through them, identify patterns. And then that list that I come down to is usually 20, 25%, right, out of 300 yesterday, because I did it yesterday. I do it every Thursday. There was 334 stocks to start. That got knocked down to 57 of something I saw, because it's just a quick look. It takes 10 minutes. 334, it's just flick, flick, flick. You're looking at it real quick and just flagging it if there's a pattern I see. Narrow that down to 54, 57. And then I go through a little more in depth to the ones that I saw a pattern, and about half of them usually stay. The other half are like, yeah, that wasn't really a good enough pattern to justify creating a plan. So then I have, between 20 and 30 typically every week of candidates. And that's all I watch for the week. That's all I trade. And I'm looking for the pattern to develop, form, and play out. And I have a plan on there. It says, here's the entry, here's the stop, here's the target. And then I just watch and see what happens. And if one triggers, it triggers. If it's close, I put an order in there and wait for it to hit. And if it hits, then I manage the trade. So it's really not super complicated. Trading is actually, when you really break it down to the nuts and bolts, it's not that complex. It's just that there's so much information swirling around there and so many different ways to do it. It boggles your mind. And I've been off in the weeds many times, and every time it's like, just come back to the basics. Just stick to the basics and keep it simple. But essentially, Weekly Whispers is me going through and showing my analysis. I started off looking at the big picture, like what's my macro analysis? What does the big picture look like? What is the news coming out? And then I moved to reviewing the previous week real quick, looking at what happened, what triggered, what didn't, how I moved stops, where I did this. Excuse me. And then we look at the next week's candidates. And then if I have time, and it's not super long, I'll go into looking at which option I would buy for a few of the candidates. So I don't do that with every single candidate, because when I first started doing it, they were taking 2 hours to get through all that. So now I just pick 4 or 5 of my favorite candidates in the list, and we look at options on those. But what I started doing a couple of months ago was breaking that out into 4 sections. So I have my macro analysis in the beginning. The second part is review of last week. The third part is this week's candidates. And then the last part is the options. So now if you have Weekly Whispers, you can just go to the one part. If you don't care about my macro perspective, don't look at that. If you don't want to review last week, skip to here's the candidates for this week. So now you can watch each section however you want. And some are 10 minutes, sometimes they're 45. It just depends on how many candidates there are and how in depth and how many squirrels I find. Right? So anyway, that's essentially what that is. It's just once a week, I give you a long, in-depth. Last night was an hour and 22 minutes. But again, it's broken into 4 sections. And then Tuesday, I do a midweek review. So I go back and then just basically look at the candidates, what they've done, if we change stops. And that's usually about 30 to 45 minutes, somewhere in there. So you're getting a couple hours of instruction every week with the Weekly Whispers. And then Small Accounts, Big Returns is just a pre-recorded class, or it was recorded. I did that a while back. if you're working with a small account, just some ideas and tips and tricks to manage that small account, hopefully grow it to a big account, because that's the ultimate goal, right? But let's get to the subject of the day, which, if you know me, I'm not exactly bullish on this market. I haven't been since 2021. I know you're like, well, look at this last year, last 6 or 8 months. Like, I know. And yeah, have I missed some of it? Yeah. Am I upset about it? Yes and no. I mean, I've still done okay. I'm still doing fine. Did I kill it last year in 23 like I did in 22? No, I didn't. Um, Mainly because I had a bearish perspective and the market turned bullish, especially late in the year when the Fed supposedly pivoted, which is what everybody thought. And they're starting to realize, and that's why you see this drop off in the last couple of months. They're starting to realize that inflation is ticking back up, and the Fed isn't going to pivot like people were expecting. And that's what caused that big rally. And the reason is because people have figured out that in the last several cycles where the Fed has tightened, once they pivot, right, they tighten, the market usually drops off. We go into a bear market or the market crashes. And once they stop tightening, as soon as they pivot from tightening to easing, or they stop tightening, that's when the market bottoms out. And a lot of people have figured this out. So they prepare and they go, okay, as soon as the Fed pivots, we're going to buy. They sit their money on the sidelines and wait for the Fed to change direction. That's why we had that blast off in October of last year, I think it was. And it just kept going. And a lot of these analysts were out saying, oh, we're going to get 6 or 7 rate cuts next year. And it's like, I don't know what you guys are looking at, but there's a lot of underlying data that shows that there are some storms brewing, some red flags, whatever you want to call them, that, yeah, I don't think inflation is going to slow down. So if inflation doesn't slow down, and that was the Fed, and I think Jay Powell made a massive mistake in going out and predicting that, well, we're on a trajectory down, and if it keeps going, then we're going to start cutting rates next year if it continues on this path, which is predicting effectively, saying that we expect this to happen, so therefore we're going to say this is what we're going to do, which is not necessarily bad. But as the Fed, I think they should stay a little more neutral and not make predictions like that and say this is what we expect to do. I mean, on one hand, I get it. On the other hand, it's like, just say this is what we have. But that's the thing, is the market got all excited and jacked up about we're going to get rate cuts. And a lot of these analysts, which I don't put a lot of stock in what they say anyway, like, oh, we're going to get 7 rate cuts next year. And in the last couple of months, a lot of them have now had to shift their perspective, go, well, maybe we won't. They were expecting a rate cut in March. That didn't happen. And then June was off the table, or May, a month or so. People started to talk, well, that's off the table. They're not going to cut. Maybe they'll get a rate cut in June or July, whenever the next one is. But now people are starting to finally wake up to reality that inflation is not done. It's going to continue. It looks like it's going to continue even more. So Jay Powell really can't cut rates unless something dramatic happens. And even then, I don't think that's going to happen. So I don't see any rate cuts coming this year. I've been saying that for a while. I think this move that we had in the last 6 to 8 months is overdone. It is purely emotional. It is irrational exuberance, as far as I can see. There is so much underlying macro data that are red flags. And one I just found out about a week or two ago, Discover, don't quote me, I have to go back and look at the exact numbers, but I think their charge-off rate rose to 5.6%, I think is what it was. And when a credit card company is charging off bad debts, that usually means they're 6 months old, which means somebody hadn't paid at all for 6 months. So they charge them off, they sell them off to a collection agency and charge them off as a loss, right? 5.6, that level, I think their normal level, if I remember right, was between 2 and 3%. That's kind of standard normal. It's climbed up to 5.6%, which is approximately what it did in 07. And then when 08, the housing market crashed, it spiked up even higher. But Discover has had their charge-off rate climb quite a bit, it sounds like. So that's a massive red flag. If people just stop paying their bills, then their credit card bills, then yeah, that's an issue. And credit cards are at all-time highs. The interest rates are higher than ever, and people are struggling. Starbucks, I don't know if y'all saw the earnings a couple days ago on that. They missed. I think I heard that it was one of their biggest misses ever for earnings expectation. So they got blitzed by what, 15% overnight. Which, if you think about it, what is Starbucks? Right? You got, people that go to Starbucks on a regular basis. If things start to get tight and money's tight, maybe they lose a job, maybe they're spending so much more that they look at their budget. They're like, I'm dropping 100, 150 bucks a month at Starbucks. Maybe I should only go once a week instead of 5 times a week. It's not really a luxury purchase, but it is a discretionary purchase that you really don't need. You don't need a fancy coffee that costs $6 or $7. So people cut it out. They start making it at home. They find cheaper ways to get their coffee. So is that hardcore evidence? No, it's anecdotal though, that says that the middle income earners, the people in the middle of the bracket that go to Starbucks, are cutting back on what they're doing as far as how much coffee they buy. So that's, I think, another red flag to me. Yeah, I know. Anyway, so there are a lot of oh, interesting, Les. Starbucks has a contract with Marriott, so more conferences online, less coffee. That makes a lot of sense. So yeah, it's just, if you pay attention, you peel the onion back, and you look deeper than what the mainstream media will tell you, the talking heads, as Brenda just said. I'll comment on that in a second. But and that's one of the reasons I look back and go, okay, these people that are on CBC and all this other stuff, they have a lot of them, not all of them, but a lot of them have an agenda, right? If they're portfolio managers, if they're this, their goal is to get the market to go up. So they'll come on and say things if they need to. And it's a little conspiratorial, and some of them may believe it, but their job is to pump up the stocks. So we have to turn this thing off. Let me shut it down real quick. So again, you got to, if you just have a curious mind and you ask some questions, it's like, okay, so-and-so is saying this. What is their motivation? Do they have an underlying motivation? Do they have a reason to be saying that? Okay. I love Peter Schiff. Guy's awesome. He's the type of guy that peels the onion back. That's why I like watching him. And he really dives deep into the data. But then he also talks a lot about gold, but he owns a company that sells gold and manages gold funds. So when he's talking about pumping up gold and saying I think gold's going to do this and this and this, and he's got a very, very bearish view on the economy, and he has for a long time. He started ringing the alarm in 2005. 3 years before the real estate bubble crashed. So, and the guy knows his stuff. But every time he comes out and starts talking about gold, it's like, in my mind, even though he's credible and his data is accurate, it's like he's got a motivation to pump gold, right? So I also happen to believe that he's right and he's accurate, and obviously gold has done that. It's jumped. It was at 2,000, and he even said, 2,000 is going to be cheap. That's going to be the floor, and it danced there for about 2 months. And what's it at now? 23 something? Yeah, 2304. I just traded it this morning a couple of times. I should know exactly where it's at. It's dancing around 2,300. I think it may drop back to 22. If it breaks below 23 and stays there for a little bit, it'll probably drop off to about 22. That's the next level of support. But it's likely to go higher. Actually, you know what? I'm glad you said that too, Brenda. That's one thing I like about him, though. He is upfront about it. He has a motivation, but he doesn't hide it. A lot of people have a hidden agenda. He doesn't hide it. He makes it clear. He goes, yeah, I'm bearish on the market. I'm bullish on gold. I have a gold fund. I sell gold, physical gold and silver. And he doesn't hide the fact that he's promoting his own company. So he doesn't have a hidden agenda. That's why I like him. That's why he has credibility, because he doesn't hide the fact that he's got some other motivation. He's upfront about it, which is what I like. Just be transparent. That's all I care about. Just be honest. So, but How do you protect the portfolio long-term if you have it? How do you actually accelerate it? We're going to look at numerous different ways that you can use options or other mechanisms, not only to protect your portfolio, because that's usually what we talk about, right? Is protecting. But this is protect and improve, right? Because just protecting it is good. But what if you could also grow it? Right? What if you could increase the size of your holdings? Maybe you own something. Let's just use Apple, for example. Let me hit what Brenda said. I forgot to mention that. She said, talking heads this morning said, since the job report was low, that Powell said that they're looking for a 50 basis point cut to September, December. I didn't hear them talking about that, but I wasn't really paying attention to them either. So I usually don't turn CNBC on unless I get bored or I need some background noise. Or if there's news coming out, sometimes I'll watch. If the market does something crazy, it's like I'll turn it on to see what they're saying. But yeah, that's funny. I said that last night too when we were recording the Weekly Whispers. Excuse me. I said I won't be surprised if we have a bad jobs report if this market bolts to the upside. And sure enough, I turned my machine on and I slept in a little bit this morning. I didn't get up till 6. And and that news comes out at 5:30. And I saw the futures up 400 something on the Dow and, massively up on all 4 markets. And it was like, oh, the job report was probably bad. Sure enough, I go look up yep, the job report was bad. I'm like, it's so weird. It's so counterintuitive because a lot of people say that. There's a lot of people coming out going, well, Tesla came out and missed their earnings, but the stock goes up. That doesn't make any sense. And then people they come out, they beat their earnings, but the stock's getting hammered. Because the market doesn't look backwards. They look forward. They don't care what you did last quarter. Okay, you beat earnings expectations. Whoop-de-doo. What are you going to do for me? What have you done for me lately, right? What are you going to do for me next quarter? So if they come out and say good things, that, hey, we're growing, things are going to be better next quarter, this is it, then the stock will likely go up. If they come out and say it's bad, nobody really cares about what happened last quarter. Tesla, I think they missed, if I remember, but they went up because they came out and said, well, this and the self-driving cars are better, or the taxi, whatever it is they're working on. That's better. That's closer to completion. So could be a major profit driver. So they came out and said the future looks bright. And they're making moves to make sure that they are healthy financially. So that's the way it works. People don't care what happened last quarter. Market looks 6 to 9 months out, not 3 months behind. So you got to remember that. And the reason that with the unemployment is that the market is desperately wanting a rate cut. They desperately want the Fed to pivot. And so any news that comes out that indicates that the Fed will loosen policy, they get excited about and they start buying, which to me is backwards and insane, but that's the way a lot of people in the market think. It's like, good. The market is so focused, it has been for a year and a half, 2 years. Ever since the Fed started raising rates, the only thing they pay attention to, the major thing I should say, no, not the only thing, but the major thing they pay attention to is when is the Fed going to start cutting? Because of that pivot part, right? And it's done it several times. The last few cycles that we've had, that's what it does. So now they're using that as a way to say, that's time to get in. I think long-term they're wrong myself, but then again, I was wrong last year too. I expected the market to continue to drop from 22 into 23, but it didn't. It kind of stagnated. And then Powell comes out and pivots and it takes off. So I was wrong too. I've been wrong at least once, maybe twice in the last hour. Yeah, I don't think it was a bad enough report for Powell to make any moves myself, but who knows? I mean, there's a few months between now and September. So I will probably have another jobs report before the next meeting, I think. But I don't know. I don't pay that close attention to when the meetings. I don't know when they're coming out exactly. I see it on the calendar when we're looking at news. So last year I actually missed one. I didn't even see it on the schedule. I'm like, oops. So thanks for the segue. That's what I was just about to do. I'm beating you to this punch now, Brenda. So, for example, I'm just going to go with Apple because it's on my screen. It had earnings. And let's say you own Apple. Let's say you own 1,000 shares of Apple. And you like to buy more, right? A lot of people call it, well, it is dollar cost averaging, right? DCA, dollar cost averaging. You buy more if it drops. But what if you don't have cash to do that? Or what if you don't want to fund more with your own cash? What if you could take money out of the market, out of Apple stock, to fund the new purchase? Let's say it's, well, Apple's at 184 right now and change. Let's say you're expected to drop to 150 and you have 1,000 shares, but you'd like to have 1,100 shares or maybe 1,200. You'd like to increase the size of your position in Apple for a long-term portfolio. But instead of paying for it out of pocket with your own money, there's lots of things you could do. Let's say you buy a put, maybe say a 175 put. If it drops to 150, what do you have? You sell your put, you take that cash, and boom, buy some more. If it continues to fall, there's lots of different ways you can look at it, right? You can do it. That's just, I'm just wetting the whistle right now. But what I want to do is, look at the big picture perspective first. That's not what I wanted. That's what I wanted. Give me top down. Look at the SPX. Get rid of that. Whoops, that's not what I wanted. I don't want a snapshot. I want Control G. So actually we need monthly. I'm going to, that's the whole thing. Let's go weekly actually, and then I'm going to pull back. I want to have a little, try to have it as big as possible for you. Well, let's go right there. Let's zoom that out a little bit. So this is the 2000 crash, right? Yep. Let's say, and I'm going to look at it from a market perspective first. We'll just take kind of a big picture. Let's say you look at this run, the kind of the insanity that it is, right? I mean, you're talking from, what's that, 94, it was 450. And 5 years later, it's 1,500, which is threefold, 300% increase in 5 years. That is not normal. It is severely overheated. And you start to see some signs. There's double top, kind of a quasi head and shoulders. It's not a pretty one, but let's say that you believe this market is, the market is overheated. How come that's still on there? I thought I deleted that. Let's say you think the market is overheated and you think it's going to go down. Now, let's just say you have a $100,000 portfolio up in this arena when it's at 1,500. If you held that portfolio, right? Let's just say you have something broad that, well, this is, oh yeah, that's the SPX. This is broad. It goes from 1,500 down to 825. It gets cut down by 40%. Your $100,000 is now only worth 60 grand, right? What if you would have taken profits there? What if you would have cashed out your $100,000 somewhere up in here, up around, 1,350, 14, let's just call it 1,400 on average. Let's say you get out at 1,400 on average. You take your 100 grand and run. Then when it comes down to here, you go, well, you know what? And maybe you would have rebought here. You go, it's too far, but there's no indication here that we're going to change course yet. So you wait and wait and wait patiently. You sit on your $100,000. You don't do anything with it. Again, it's hypothetical. And let's just say you sit there and just wait. You go, I'm going to wait for the market to finish its crash, which we never know when it's done, right? We never know when it's going to crash or if it's going to crash. Well, we know it's going to crash. At some point, the market's going to crash. When, where, how bad? That's the only question. It always does. It's happened throughout history. It always will. So there's a crash coming. It's just we don't know when. But let's just say you get out, right? Which isn't necessarily the wisest move because it could continue to run. I mean, you could have, what if you got out right here, right? Back in here, you look at this rally, you go, man, this thing's way overheated and starts to crash. You get out right here and you wait for something like this, and then it takes off and it goes up another 40%. Like, and you missed out on a big run, right? Welcome to the challenge of trading. That is the hard part. You don't know when things are going to change. So if you can find a happy medium, which is one reason I love to scale, you scale in, scale out, leave some there, take part of it off. You adjust your positions accordingly. But again, we're going hypothetically. You cash out about 1,400, the whole 100 grand. When it comes down here, and then you know how to recognize patterns, right? Because you had patterns in a flash. So you can see the inverted head and shoulders form here. And maybe somewhere over here on the right shoulder, you're like, well, I'm going to get ahead of this a little bit, even though you should wait for the breakout. Maybe you just start picking a little bit up here. Okay, we made a lower low, a lower low. Here we've got a higher low. It's starting to rally up here. So we've got a higher low. We don't have a higher high yet, but we do have a higher low. So you say, you know what? I'm going to throw 10, 20,000 of that back into the market and put it to work. So you put a little bit in there, then it rallies up, pulls back a little bit, and then it runs up and it hits that neckline, right? If we draw the neckline on there, you're like, okay, well, you know what? If it breaks out of that neckline, I'm going to put a little bit to work here. Maybe as it comes up here, you go, okay, I'm going to nibble a little bit more. Maybe you put 10 grand to work here, then you put 10 grand, 10 or 15 here. So if it breaks out of that neckline and heads north, I'm going to put the whole thing back to work. And you go back and you rebuy all the stocks that you had before or the companies that you want now, right? And now you've got your $100,000 that you cashed out up here. Now you're buying these all back significantly cheaper, right? And as the market goes, now you're 100,000. I mean, you're literally, if you're back in it, say 950, up to 1,500, that's what, 60, 75%, somewhere in there. Now your $100,000 is worth approximately 150 to 175,000. Whereas if you had have just held through this big giant dip for a year and a half, 2 years, here you are, you know, at 99, 2000, middle of 2000 at 100,000. 6, 7 years later, you've just gotten back to break even. Whereas if you would have taken measures to take advantage of or protect yourself from this decline, then now you redeploy the money down here and now you're up 60, 70% versus being break even. That's a massive difference, right? So it's that's really what I want to look at, because I do believe that we're getting closer and closer to that right there. There's the 08, right? This one was a little more obvious. See, this is not a nice, clean, clear head and shoulders at all. Double top, yeah, you could argue that. This is a very nice head and shoulders. Right, let me. And it pretty much played out textbook. Left shoulder, head, right shoulder. The lower right shoulder is better. In other words, we didn't make a higher high, right? We're making higher highs here. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, lower high. Uh-oh, red flag, which I found 5 or 10 different head and shoulders. I saw lots of little, they were ugly head and shoulders. They weren't this nice. But several cropped up this week that I haven't seen before. And what you'll see is that the patterns, you will see the same patterns when the overall market or when certain stocks show the pattern and you start to see them, the overall market shows the pattern. So you'll get this grouping of patterns. And that's one of the reasons I like going through 300 stocks every week, is because I can a lot of times see there's a pattern that's shown up on a lot of these stocks. And there's a lot of head and shoulders that have shown up this week on a lot of stocks. And they're not, again, they're not very pretty, but they're there. So there's signs of weakness is what it is. And obviously that can change at any point with news, just like it did last October. So I agree, Jennifer. She says, I find trading a wackadoodle on my mind. Went in, went out, bad move, good move. So yeah, and that is the tricky part of trading. And again, that's one reason that I love to scale. First of all, if you use risk reward well and you manage your risk well and you focus on your risk, then eventually you'll have one of those big movers. I'm cranky that I missed literally by about 10 seconds this morning. I missed a 20-point move on gold in like 10 minutes. I was so frustrated. I'm like, it's killing me. Because I literally had the order ready. I almost pulled the trigger and I didn't. I'm like, I missed the entry point. It moved too far away from the entry point. And then it just kept going. It just cratered. And I'm like, there's a $500 to $750 trade in 8 minutes or something like that. It did it. And I'm like, but, and that was just a small position. Do a big position, it would be at, 3 or 4 grand. But welcome to trading. That's the way things go. You're going to miss stuff all the time, and it's going to frustrate the heck out of you. You're going to get into trades that go against you and stop you out. It's going to frustrate the heck out of you. It's the nature of the beast, right? This cough's creeping back in. But again, going back to looking at, say it was the end of 99. If you cashed out, now, up here, we're back at 1,500 on the overall market like we were before in 99, 2000. but you cashed out, or at least you did what you could to protect the downside and reinvested when it got down to the bottom. Now your $100,000 that would have been just breaking even is now 160 or 170. And you recognize the head and shoulders because you measure patterns in Flash. And you're like, wait a minute. That's a warning sign. I'm going to do something to protect my portfolio, something to make sure that if it does crash, if the market collapses, then I can buy more. So now let's just say, again, for example, say you cash out the entire 100, let's just call it 150. Let's be conservative. Now you got 150 grand. Market collapses, 1,500 down to 750. This time it cuts in half, not 40%, but 50, 55%. And it just goes, and you're like, ooh, oh, look at that. Another inverted head and shoulders, just like we had in 0102. There's an inverted head and shoulders, left shoulder, head, right shoulder. You might even take this as a capitulation move when it really craters like this and say, you know what? This thing's really oversold. Let's take 10 or 15,000 of that 150 grand we got sitting on the sidelines and deploy it here. And you say, okay, if it gets to 750, that's a 50% drop. So you put an order maybe down here. You put an order below the market at 750 and start to nibble on, and you pick up a little bit. You take 10% of your 150 grand. You say, I'm going to pick up 15,000 down here. So you pick up a little bit at 750. And then it starts to bounce. Like, ooh, all right. And then you see the head and shoulders like, all right, well, let's go. If it breaks out of there, let's redeploy most or all of it. Now you're putting 150 grand back to work instead of just 100, right? Again, you would have gone from, you get in here, you're at 100,000 here, you ride this down, you come back, oh, I'm back at 100,000. Woo! You ride this down, you're like, well, right now you're only back at $70,000, $80,000. But in reality, if you protect this from the drop, you're now at 150. Now you're at 150. You're redeployed. Your 150 is redeployed, and you're up, what, 30% from there? So you're at a little over 200 grand. Again, you just keep moving this thing forward. Whoops. Well, that's okay. Realistically, there's what you look at, right? Okay. There's 2,000 on the left-hand side. You redeploy the 150, or you redeploy the 100, you're at 150. Now you redeploy the 150, and you ride this thing up. Now your little 150 is, you're talking 750. You're back in, let's just say you're back in an average, let's say an average of 1,000, right, is where you buy back in. And over the next 10 years, it triples. So your 150 is now worth 450. Had you done nothing, okay? Had you done nothing back here, you're at 100,000, you're at 60,000. You're back to 100,000, you're at 45 or 50,000. You're 40, let's just call it 50 to make it easy. Your 50 triples to 150. If you take measures to not endure this and just hold, you're 150, just holding here, you're from 100 to 150. By taking advantage of this dip, you're now at 450. You're literally 3 times as much money because you learned to recognize the pattern. You learned to mitigate the risk and protect from the downside. And say, okay, if this happens, let's do this. Let's protect it. Does that make sense? Yeah, welcome to trading, Jennifer. Yeah, and that is literally that is a challenge, and I deal with it all day long. I have the same thing happen, and you know what? Just so what she said. So if she says I've been scaling out pretty well. In other words, taking out, if you get into say 10 contracts, you take out 2 here, 2 there, 5 there, whatever it is based on what the chart's saying, right? You take your profit on some, which reduces your risk and banks your profit. It dramatically reduces the chances of taking a loss, right? You go all in or all out, which there's not necessarily anything wrong with it, but it doesn't leave the upside open, which is what scaling out does, right? It leaves the upside open. So if it continues to move in your direction, then you're still making profits. But if it backs up against you, then you have less risk on the table. Because you've probably all had that experience if you've traded where you get into a trade, you're all in, you get all out, and then it keeps going. And you're like, I should have stayed in, right? And you're kicking yourself because you left money on the table. You've probably also been in that situation where you get in, it runs in your favor, you're up a little bit, you're like, woo, all right. And then it turns and goes against you. And you take a loss. You're like, I should have gotten out. I should have just taken my profit. And so what you do is get stuck in this mental fear cycle where you get into a trade and it moves a little bit in your direction. It's 20% of the way to the target. And you say, I don't want to lose my profit like I did last time. So you take all the profit and then it keeps running. And now you're kicking yourself for getting out too early. Right? You have this mental fear tug of war going on inside your head. Scaling out helps that, right? You get up 20%, let me take 20% of the trade out. Take some off the table. If it backs up against me, then I don't lose as much. I have a smaller risk. If it keeps going, I'm still making profit. It's a way to manage the fear. It's a beautiful way to manage the fear. But you're always going to have that though too. But you know what? I'll bet if you watch and you pay attention, and this is the thing I talk a little bit about memory sometimes, that I'll bet you, because you're saying most of the time instead of the last one or two contracts going the direction I wanted, it would have been better if I would have gotten out of the whole thing. But there will be those times, okay, that the one or two contracts, it'll keep running. And just make sure that when you see that happen, and it does happen, don't forget that one. Because it's easy to remember the ones that we get frustrated by, like, right? We remember the ones we want to, not necessarily everything. And so it's easy to twist and warp our own minds into believing that I'm always missing this, I'm always missing that. And it's like, you got to remember the ones that you didn't. Like yesterday, I got ticked out, literally by a tick. I got stopped out of oil. Literally, it hit my stop and then turned and dropped. I was short, right? So I wanted it to go down. It hit my stop. It was 17. It was something 79.17, 81.17, something like that. It hit my stop and then turned and dropped 60 or 70 cents. So I ended up taking, it wasn't a big hit. It was $40 or $80 or something like that. But had it not ticked me out, I would have banked $200 or $300 of profit, like 10 minutes later. And I was like, ugh. But there's other times where I had an order sitting there to get in and it missed me by one tick. And had it ticked me into the trade, I would have lost. I would have gotten stopped out and taken a hit on it. So you're going to have it go both ways. And the key to it is remembering and logging the memories that say, okay, I saved, what's the phrase? It's on the tip of my tongue. Dodged a bullet. There's lots of them like that, right? I dodged a bullet on that one. So yeah, exactly. Even when the last two contracts go the wrong way, I still usually make a profit. But it is still frustrating. And but I don't think that's ever going to change. It hasn't changed for me. And I don't see it changing. It's the nature of the beast. Because again, you're going to have those that they still go. And you know what happens, especially if you're a day trader, and I've started day trading futures in the last year or so, like the gold one this morning. I got into it, I was long, and the trailing stops went up, hit them, and then it fell back like 5 or 6 points, took all my stops out. I was still profitable, but then it turns around and takes off. And it made a 15-point run where if I would have stayed in, even just one or two contracts, because it pulled back far enough that it stopped me out of everything. I had like a 6-point swing. But then 30 minutes later, it's up 10 or 15 more points. It's like, how do I capture that bigger move and endure those swings? And it's tricky. It's not an easy thing to do. You've got to figure out, first of all, how big does that particular instrument move, right? Each stock is different. If you're trading NVIDIA, you put a stop 2 points away, you're going to get stopped out in about 3 seconds. If you're trading Alcoa, 2 points is going to take a week or two, right? So you have to adapt to what instrument you're trading, what stock you're trading, what instrument you're trading. And it's a challenging thing to do. It really is, trying to figure out, where can I put my stop where I minimize my risk, but I leave the upside open for hopefully a bigger run. It is tricky, and it's not easy to figure out. I mean, 24 years in, and I'm still tweaking it, trying to master the part where I get it exact. And you're never going to get it exact, right? It's like baseball. I talk about baseball all the time because baseball player steps up to the plate, and you've got so many variables, so many factors, and you've got a different pitcher. So you got to know who the pitcher is, what kind of pitches they throw, what inning is it, what's the score. Well, there's so many different and that's what baseball players do, right? They analyze the situation, go based on this. Here's what I think, and based on this pitcher, they study the pitchers, what they do, how they throw. They have a curveball, they have a slider, right? There's so many pieces to it, and then you literally have this little tiny ball coming at you at 85, 90 miles an hour, 100 miles an hour for some, and you got this bat. You got to get it around. You got to make a decision in a split second, and then you got to get the bat swung to make contact with the ball. And then if you make contact, it's got to go in the right place. So trading isn't much different. And if you look at it from a baseball perspective, or any sport for that matter, to get to the level where you are a professional is not easy. It's very difficult. Very few people make it to that level. Trading is a lot like batting in baseball. And baseball players, the ones that are batting 290, 300, are killing it, right? They're doing well. Excuse me. And that's the beauty in trading. If you use risk reward properly and you scale properly and you figure out how to systemize that and create something that works for you on a regular basis, then it's just like being a baseball player. The ones that are consistent, they get consistent hits, they hit 300 year after year after year, they go to the Hall of Fame. 300 is only 30%. 30% of the time they go to the plate, they get a hit. That's it. 30% doesn't sound like much, but that's a Hall of Fame stat. And the beauty is in trading, you can do that. You get base hits, doubles once in a while, triples, you get the occasional home run, which is what pays the bills, right? You get some wins, some losses, you strike out, you walk, you get these, and 30% of the time, you get a hit, and maybe 10% of that 30%, you're getting a home run. So it's the same thing. And you have to step up to the plate and swing the bat. And you have to, that's really all trading is. And one of the things, the reason I use that is that it helps me in my own mind to realize and recognize that here's professional baseball players. It's a game I've been playing my whole life. I know it. I mean, I don't play it now, but I grew up playing baseball and other sports. Is that you have to get in the batter's box and swing the bat. You can't get a hit sitting in the dugout. So, yeah. Holy cow. It's worse than it's been in a while. Yeah, I know, Brandon, I'm getting there. Yeah, I think the big thing is, actually it probably is. You would think I have a big dog here. There's so much hair in my office just floating around on the floor. It's like, it's crazy. It looks like a giant dog lives here. But yeah, that could be what it is. I think here's the key, Jennifer, because I think this is so much better than having an old job, right? Trading it's a business like any business, right? It can be cyclical. You're going to have good months. You're going to have bad months. It's like everything in life, right? And baseball players go on streaks, right? They have a killer streak where they just kill it, and they have bad streaks. The key and what differentiates the professionals that are in the pros playing baseball or any sport is that they bounce back from defeat quickly. They don't let the mental game is the hardest part. And you're going to have lots of defeats in trading all the time. Every day you're going to have something happen that's like, well, I should have done it, woulda, shoulda, coulda. And you got to look at it, and you got to compartmentalize all the stuff, and you got to go, okay, how could it's like this, like, how could you have known this was going to happen? And that's a question I learned to ask myself. Because after things play out, you go, oh, well, this and this. Well, yeah, it's easy to see after the fact. Hindsight's 20/20. But if you back the chart up, you go, how could I have known before that? How could I have suspected that was going to happen? I didn't know. So that's a mental thing you've got to break through, and you've got to recognize that before it happens, you don't know. It's easy to see after the fact. And so I've trained myself to ask the question, like, how could I have known that was going to happen? Like the gold trade this morning. I didn't know it was going to drop 20 points in 5, 6, 7 minutes. I was looking at breaking a support. Had I known it was going to do that, and then after the fact, I'm like, But that's the thing. You don't know. The beauty is that I bounced back from it. I was frustrated, but I thought, okay, this thing's way oversold. It's probably going to bounce. So I took advantage of the opportunity when it created a little double bottom. Now I jumped on it and traded the bullish side. There's a differentiator. And it's still something I have to work at. Professional baseball players do every day too. Okay, I just had a bad at bat. I struck out, let the team down. I have to go out and play defense now. You don't have time to sit and beat yourself up. Yeah, exactly true. All right, so I'm going to use Amazon, Brenda, because I don't want to look at the ETFs, even though it could work. But I want to use an actual stock. So what I'm going to do in the last 9 or 10 minutes is what's going on there. Let's look at one and say, okay, what would happen? What could we do? I mean, look at Amazon. Let's say you own Amazon. Let's say you own 1,000 shares right now, and you're looking at it going, well, we're at all-time highs. Okay, that is a weekly chart. We're at the all-time highs. And obviously it could break out. What if it does? If it does, then obviously you like it. If you own 1,000 shares, but what if it does this again? You know, there's what, 21, 22. Again, going back, we look at the SPX example, you go, okay, but what if I would have, and I'm not saying cash out. In fact, let me do that. So here's basically kind of 4 different ways. There's a lot of different ways to do it, right? You could sell the stock, right? If you think a stock is peaked out, you could sell the stock. But if it's a long-term hold and you have capital gains, that obviously could create a tax scenario that you want to be cautious of. So if you have a long-term portfolio and you want to hold on to it, then that's probably not an option. You could buy some puts, right? You could buy some insurance. You could collar it, which is selling the calls and buying the puts. So if you don't want to pay for the puts out of pocket, you could sell some calls above the stock and use that to fund your insurance, right? But that is also giving up the upside if it runs. Kind of. You can always close it out, right? You can always buy the call back, so you're not obligated to sell it. You can reverse that position, so you're not locked in selling it. So that's a problem. You could do deep in the money calls, right? But you got to make sure one of the things about that, if you do deep in the money calls, if there's no time value in them, that dramatically increases the chances of an early exercise, because there's no reason for them to wait if there's no time value. But if that did happen to you, you could always do an SDS, same day substitution. So if you get a call from your broker, you sell some deep in the money calls. Let's say you sell the 150s on Amazon, right? Go back to the stock. Where did the stock go? What is going on? That's weird. All right, forget it. I'm done with that. Let's say you sell a 150 calls, which is way down here. Maybe you can do the hunters, right? You get $85 for it. Uh-oh, something's going on with the mega charts. Of course. I'm going to close and reboot it. So say you sell the $100 calls. If there is no time value in it, there's no reason for the market makers to wait to exercise it. See, that frustrates me. 292 is double bottom. That's where I grabbed some of this right here. And this is where I did this the other day. I caught the very bottom at 292 and wrote it and got a decent amount. That's gold right there in the bottom right. You can kind of see it, but I don't have time to keep going on it, so I'm not going to. Whoops. Again. Keep doing Control S. I want Control G, S, A, M, Z. So if you were to sell the deep in the money calls and they exercise them early, you can do a same day substitution. Your broker calls you and says you were assigned, or you sold your Amazon stock. You say, well, go rebuy it, right? There's the wash sale rule. Go rebuy it. Do a same day substitution. In other words, they place an order to rebuy the stock and it's selling. It doesn't settle till the next day or 3 days, whatever. So they basically just cross and you're back in the same position you were before. So it's not that big of a deal if you get bought out early, right? It can be remedied basically. Oh, I appreciate that, Trip. I kind of figured that because their earnings, the little earnings thing, and this is a good way to know. Genesis, who is the data provider that built this platform and provides the data for it, they're having issues with their earnings data, Trip said. So, and I always tell people anyway, make sure they have these little diamonds on here that says when earnings is. And I noticed some of them are jumping. My candidates last week, because I'll go look on Toss and see what it says, and I'll put a vertical line of when earnings is, when I need to be out of a trade. And some this last week, last night when I was reviewing them for the Weekly Whisper subscribers, I was reviewing the ones, and the earnings triangle moved like a week out when I had the line there and earnings came out already. So yeah, I saw that. I figured that was the case, but I don't. I always double check. And no matter what platform you have, it's good to have 2 or 3 sources, because sometimes one is off and the other one is good. So anyway, looking at. In fact, let me get. Let me get my, where we go, some options data out here. So lots of different ways to, where is Amazon? I guess I'll just type it in. Oh, come on. AMZN. There we go. So let's say you want to buy more Amazon. You own 1,000 and you're looking at this going, well, that's pretty high. And if it does this again, I'd like to buy some more at 100. So again, you could just sell the stock and just wait for it. Which obviously, if you do that, you give up the upside. If it breaks out and it keeps going, then you don't get the profit from it running upside, right? You could sell deep in the money calls. Let's look real quick. I'm going to pull this over here. I don't know why that cheesy thing is doing that. So let's see, how long did it take from here to there? That was December of 21, December of 22. So a year. Let's say you think about doing the next 6 months. And again, we're thinking of long-term portfolio, not necessarily. But the idea that the seed I'm trying to plant here, let's say we go to October of this year, that's 168. That's pretty close. Buy back the calls and sell the stock. Okay, Barry, I'm a little lost on that. So let's say you sell the 150s for 6 months out. 150 calls are 42.30. Oh, what am I buying back? Oh, the stock. If you sell the stock, you would buy it back, right? Because we're talking about long-term stock holds, not necessarily. I mean, we're going to utilize options to protect the downside, or actually not necessarily just to protect the downside, but to protect and improve our position, right? So you own 1,000 shares at 186. You have $186,000 there. If you sell 10 contracts here, you collect 42.40, right? That's the 150s out in October. Now, let's say it drops to 150. Let's say it drops down to, I'm going to figure some place to get the math easy. Say 100. Well, let's go 100. So it drops down to 100, say, in the next 6 months. Well, these things, well, that won't be as dramatically cool, but that's all right. So you collected 42.45. It drops to 100. You can now buy those back. Let's say it takes 5 months to get there. Let's say they're only $5 to buy back. Let's say they're $2.45 to buy back. So you collected $40,000, right? You collected $42,045 by selling 10 contracts of that $150 call for October. 4 months later, it drops to 100. You buy it back at 250. You collected $40,000 of profit. Stock's at 100. $40,000, you can buy 250 shares. Is that right? I think the math is right. If not, go with it. So you just took the drop in Amazon from 186 down to 100, and you increased your position from 1,000 shares to 1,250 shares. So instead of dollar cost averaging with your own cash, why not have the market pay you and then take that profit and roll it into the stock? And now you build a bigger position in the stocks that you love, that you want to hold for the next 10, 20, 30 years, whatever it is. So it's not just about protecting, because we often talk about protecting the downside in case the market crashes. But what if you want to build that position and make it even bigger? You could just buy puts if you wanted to. You can say, you know what, I'm going to buy the 150 puts for October. So if it crashes to 100, right, they're 271. This is the exact opposite, essentially. So now you'd put out $2,700. You'd pay $2,700 for the 150s. If it crashes to 100, those are worth $50. So you sell your $50,000 worth of options, and you go roll it into buying the stock, which is what, 500 shares? The other one was 400, I think. Yeah, it was 400 shares, whatever it is. And now you just dollar cost average, but now you're using your money from the market instead of using your cash. So now you've just increased the size of your position. Just like we're looking at the SPX, right? If you cash out at the top, that's cashing out of the stock. I wouldn't necessarily do that, especially if you're going to have tax consequences. I mean, you can do what you want, right? I can't tell you what to do, but if you don't want to sell the stock, if you want to hang on to it, that's one option. The other one is a caller, right? You could say, well, I don't want to pay 271. Let's do this for free. Okay, well, the stock's at 186. What are the odds? I mean, with the market and the economy the way it is, Amazon's probably not going to keep going north, but it very well could. Let's say, okay, let's say you want to buy the 150s for 271. What calls are going for approximately 271? Well, there's the 230s. You can sell the 230s for $3. You sell the 235s. So let's say you sell the 230s for $3. If the stock continues to run and you're okay selling it to 230, let it go. Now you just sold it for, what's that, 45, 50 bucks higher than you have it now. And then you take that $3 and you pay for the 150s. Now, if it craters to 100, like it did last year, then you take that, you didn't pay anything out of pocket. And now it drops to 100, you sell that 50,000, you buy however much you want to buy. And now you increase the size of your Amazon holding. And then realistically, which if it did that, see, you don't want to sell a call when it's down here. Of course, you never know when this is the bottom, right? But if we've already had a big drop like this and you sell a call, you're likely to get called out. The time to do a call or sell a call or buy puts is when things are at its peak and looking like it's weak, which actually, yeah, that is today. I mean, this is actually looking a little bit strong at this moment in time, but, and there's the tricky part is you got to figure out what works for you. And here's the beauty. Okay. Let's say you sell these 230 calls and it breaks out. You can always buy them back, right? And they're so far out of the money, the delta is only 18. So let's say the stock runs above 190. Let's say it hits 200. And you're like, I don't want to sell them. I don't want to sell it at 230. Well, a 10-point move in the stock is going to move this about $2, right? So you buy it back. You say, okay, it's going for, let's say it's going for $5 to buy it. You buy it back for $5. You take your $2,000 hit, but realistically, you made another $10,000, $15,000 in the stock. So yeah, you took a little bit of a beat up on the option, but you open up the upside and leave it alone. You could keep the put there then if you want, or you could resell out. You could either go out to another month and say sell higher and recollect that. Let's say you buy it back for $5, and then say you go out to November. You're like, well, I don't want to be out of pocket any money to close it out. So you close this one out for $5, the October 230s. Maybe you go out to the November 230. Let's see what's going for $5 here. There's the 225s, the 230. So November 230s, which is what, another month. It's only another month, are going for 470. So you can literally roll out another month, close out the Octobers, roll out another month, and have zero or very little out of pocket. There's just so many different ways you can do this. But really the concept that I wanted to drop out there as an idea for you today is that if you want to increase your position size, it's not just about protecting the downside and cashing in from the downside, but if you have stocks you want to own long-term and you want to accumulate more of it, then use this as a strategy to do that. And you could realistically do it on a shorter term basis. I'm looking at, 6 months to a year's time frame to protect from a major crash. But let's say you have 1,000 shares and you think, if Amazon, maybe it creates a double top here. If it comes up and hits 190 and rolls over, we've got a double top at 190. Maybe look at it and say, you know what, I'm going to sell the 190s right here. And now you just trade it short term like you would anything else. I'm going to sell the 190 calls. They're 224. You collect, well, yeah, they'll be worth a little bit. Well, yeah, that's a little bit out of the money. What's the at the monies? Let's say it's at the money. Okay, $3. Let's just call it $3. So you collect $3,000 on the call. If it drops off in the next 14 days and it expires, you have $3,000 more. Now you go buy $3,000 worth of Amazon stock by collecting the covered call. I know that's basic, but the main thing that I was looking at is if we have a massive drop, you can capitalize on that and acquire a lot more. You can do it on a short-term basis too. I just think it's bigger potential with a longer term. So yeah, it is recorded, Jennifer. It should be. They usually put it up on YouTube. I think it's a few days or a week or so after So there should be one of these on YouTube. Because yeah, that's where I'm pretty sure they put them all up on there. They used to. I'm nearly certain they do. I get notifications that say it's on there. So, and I think I saw Brandon or something like that last week. It popped up and said, here's the Trading Coaches Playbook with Brandon. I've seen it pop up with me too, which is kind of weird because then I go watch the video and I'm like, I do talk fast, huh? It's like, do I sound stupid? I don't know. I just come in here have fun. So anyway, holy cow, we're overtime. So yeah, I mean, there's a lot of different ways you can do it, right? You just have to figure out, what stock you have. Some have lots of volatility, some don't. Amazon's a good one to look at, but you have to look at the risk and rewards. What's the upside? If you're selling calls, you're giving away upside. If you're buying puts, then obviously you're protecting the downside. There's just so many ways to go about it. Deep in the money calls is one way to do it without putting any cash out of pocket. That's one I would actually do on a shorter term basis. If you're going to do it short term, I wouldn't sell the at the monies. I would sell some in the monies. You got 14 days here and treat it like a swing trade, right? Because you've got, well, let's see, what do we have? Let's call it 175s. 175s are going for 12.20. Let's say you think that this is the peak on Amazon. You think it's going to drop in the next 3 days. Whatever analysis you come up with, it's going to drop in the next 3 days, probably 6 or 7 points. Well, this is a delta of 90, right? So it's almost dollar for dollar. So if it drops $6, this option is going to drop approximately 5. You sell that at the money, you're getting $3. And that's 14 days if you wait for expiration, right? If it drops $6, this is going to drop about $1.50. You're only going to make $1,500. You get one that has a delta that's 90, 95, and it drops 6 points, you're going to capture about $5 of profit. So you sell this at $12.25 and you say, I'd like to make $5 on it. I collect 12,000, 1,200, or 12,000, 12,250, right? You go put a buy order at 7.25. Is that $5? You go put a buy order, a GTC, for 7.25. If the stock drops $6, it's going to buy it back at 7.25. They put 12.25 in your pocket. You gave them 7.25 back. You still got a $5 bill in your pocket. Times 1,000 shares. You got $5,000 now. So if you're a swing trader, if you can see and analyze and come up with what you think is going to be a good short-term move over a few days, and you could do this once or twice or 3 times in a month, you're doing okay. And then you take that money and buy more stock if you want it. And then you can sell more calls. Again, I'm just spitballing, just throwing ideas out there. Like, these are things you can do. Now, you obviously want to cover your risk too, because what if you sell that and the stock goes up? Well, you just buy it back to close it. It's not that big of a deal. And maybe you do that and you take a $2 hit. So, okay, you gave $2 back to the market. But the next time you get 5. It's just about risk reward and making sure you protect whatever it is you're trying to protect. Stay out of the way. So manage your risk well. Focus on your risk, and the profits will take care of themselves. So any very quick questions since I'm, holy cow, 10 minutes over. Sorry. Sorry, Lee. Of course, I mean, would you expect anything less? I mean, come on. I have too much fun doing this. So anyway, all right. Well, I appreciate you guys coming and having a little bit of fun. And again, just stay focused on your risk and run the numbers and just have fun with it. Have fun with it and build that portfolio up. Even if it crashes, you're going to be way better off long term if that does happen. So, all right, y'all have a great day. God bless. We'll see you all very soon, hopefully. Bye-bye.